Hey, it's Mike here with Trader's Edge. Today, we're going to go back to the beginning, back to the basics. I want to talk today in this video about really understanding the basics of options trading. Now, maybe you've heard of options, maybe you haven't, but they can be an extremely powerful investment tool. They can help you generate income in your investing, they can provide you a ton of leverage and opportunity, and they can also provide protection. So these can be a perfect investment vehicle if you understand and know how to use options. So I want to dive in to a lot of these fundamentals today. So let's jump in. Hey, it's Mike with Trader's Edge. Now today I want to teach you exactly why we like to trade options over stocks here at Trader's Edge Network. And I want to break down why we think it can be a better investment vehicle for you to have more opportunity, have more leverage, and just have more profits overall. So to dive into this, I wanted to start with an example I think everyone can relate to. So let's say there's a piece of real estate, a home that you're wanting to snatch up. You think this has the opportunity to appreciate in value. You think, for whatever reason, some development's going on, whatever the case may be, that this particular home has the chance of going up in value. So what are your options? Well, we could come in, we could plop down, $500,000. Most people don't have that cash just sitting around that they'd want to tie up anyway. Well, you could go through the hassle of securing a loan and, going through all that process and hope this thing goes up in value. But in the financial markets, there's option contracts. So this is what it would be like in the world of real estate. So let's say you walk into this seller and you say, hey, I'm good to buy this thing for $500,000, but I don't want to do it yet. Why don't you give me a year to decide if I want to do this? So I'm going to tie this up. I'm going to have the opportunity to buy this thing between now and a year from now. And yeah, I'm cool with that $500,000 price. Well, the seller, to have the home tied up for that long, is probably going to want a premium, right? To get it under contract, they're probably going to want some money from you. So let's say you say, all right, I get that. We're tying this thing up. How about I throw 10 grand your way? And again, we've got 1 year of time to decide if we want to buy this thing or not. Well, let's say you're right. Let's say the value of this home spikes and it jumps up 100 grand. You were right. The property appreciates, and this thing is now, you've got buyers lining up to buy this thing for $600,000. Well, remember, you have the right to buy it at $500,000. You have a contract, a piece of paper that is going to let you purchase this thing now at a $100,000 discount. So what would that piece of paper be worth? Well, someone that wants to buy that property right now, they're willing to pay $600,000, and you have the piece of paper that would let them do it, they would pay you $100,000 right there on the spot. So think about that. A $10,000 investment, you tied this thing up, you had it under contract, you paid $10,000 for it. You could now sell that piece of paper for $100,000, making a nice $90,000 profit. All right, and $90,000 having only tied up 10 grand. Now, if you would have bought the home outright, you could have made a $100,000 profit, but you would have had to tie up 500 grand in the process. All right, so in the world of the financial markets, instead of tying up cash buying the stock, we can use option contracts in the exact same way that I just showed you in this real estate example. And in fact, we can use option contracts to secure the right to sell. So if it loses value, we can make money. So we're going to dive into all of that and a lot more. So buckle up. I hope you're excited to learn some really valuable information that is going to transform the way you trade in the financial markets. All right, so we're going to take this back to the basics and really start from the ground and work up on our options knowledge here. So the first thing that we want to understand is that option contracts trade off of an underlying stock, an underlying security. So for today, just for example, we'll use the stock Apple, ticker symbol AAPL. So if you're looking at a stock chart of Apple, for example, you're going to be trading option contracts based off of that stock itself. So option contracts are going to trade off of the price of Apple shares of stock. So we call that our underlying asset. So if you go to trade options on Apple, they're going to all be based off of the stock itself. Second, we need to determine a strike price. So this is just a little bit of terminology that'll come together really quickly for you, I promise. So this is the price that we're agreeing on up front before we jump into an option contract. We select the strike price that we want to trade. So this is the price at which the option can be exercised, right? So that's the strike price. So in our real estate example, the strike price would have been $500,000. That's the price at which we were agreeing to buy the real estate at. So there's a strike price with every option contract that we trade. And then another variable that we want to select as we come in and we trade options is the expiration date. Every option contract has a shelf life. It is going to expire. But we know that up front, and we get to select the expiration date. So as we're looking to trade an option contract, we want to know which underlying stock we want to deal with. We want to know the strike price and go and select that. And then we want to know our expiration date. And I'm going to show you exactly how this is done on an option chain. All right, so here's an option chain. An option chain is where we can find the quotes or the pricing for all the different option contracts that are out there. Now, when you're dealing with just a stock, it's pretty simple. There's one price that you've got to look at, right? The price of the stock and where it's trading. So in the case of Apple right here, it's trading at about $220 in change. Now the market's open, you're going to see this price dancing around. But below this, I've pulled up an option chain to start showing you how these option contracts are quoted. And there's hundreds and hundreds, if not thousands, of option contracts that you can choose from. Now that might sound a little daunting, but don't worry. It's really pretty simple as you start to narrow in on how you want to trade these. But just so you can start putting some of this terminology together with the real life understanding. So for example, we've got Apple in here, and then underneath down here is our option chain and where we can find some of the pricing. So again, there's our underlying asset. We've got Apple here. We need to look at our strike price. And that's what we see right down the middle of the option chain here. And a lot of different financial institutions quote it this way. So this should look pretty similar. If you're in a different broker or something like that, an option chain should look pretty similar to what I've got on the screen here with Schwab. You've got calls over here on the left side, and then we've got put contracts over here on the right side. And we're going to break that down a lot more in just a second. But right down the middle, you can see right here, this is our strike price. So if Apple's trading at $220 and we want to have the right to buy Apple at $220, we'd come and look at this $220 strike price. And then the right to buy, like our real estate example, is the call option. So we can see here's the pricing. And again, it's quoted with a bid and an ask price, just like a stock would be quoted for that option contract. Now, the expiration date on this one is actually a weekly option. I'm recording this here on a Wednesday. This is looking at the Friday expiration. So this contract would expire in just 2 days. So maybe you're wanting to look at trading a little bit different time frame. Well, if you come down here, there's next week's option. Then we can go 2 weeks out. But I want to show you the bottom of this. There are option contracts way out in time. Here's as I'm recording this is over 2 months out in time. This October 18th expiration. So that would be the expiration date. Then if I wanted to, we could load even more further out in time option contracts. I could click all right here and let this load up. Then if you come down, now you can see we have option contracts going out over a year in time, right? Over 2 years in time, there are these option contracts that are out there and available for us to trade. So we get to come in and we get to select these different expiration dates and the different strike prices. And we're going to keep building our understanding on what all of that means as we keep working through this video. So before we leave this option chain, I just wanted to connect the dots here with our real estate example. So again, Apple's trading right here around $221 a share. In our real estate example, we were talking about a house that was valued at $500,000 at the time we were looking at it. So we wanted to tie up that house for a year to decide if we wanted to buy that. So if I loaded up in the world of options here, looking at Apple, here's an option contract that expires 366 days from today. So we've got a full year that I could have the right to buy Apple. And again, if we picked the strike price here of the 220, right where it's currently valued, right? Apple's currently valued right here at about 221. This is the same concept of that real estate example. So again, a call contract gives me the right to buy the stock. And again, we'll talk more about calls and puts in just a second. But this is the financial market equivalent of that real estate example. We're going our expiration date a year out in time, so August 15th, 2025. I'm recording this here August 14th of 2024. The price that I want to buy the stock, 220, again, just right where it's valued at right now. And then this is what that is trading for. Okay, again, there's a bid and an ask price. So usually when we're buying, we're going to be paying closer to the ask price. And a lot of times we can shave off of that a little bit, which we'll talk about more. But what we could probably get this for here is $27. Now, another really important piece of options trading is understanding that this is quoted per share, and every option contract represents 100 shares of stock. So the one little piece of math that your brain is just going to do automatically once you get into this is you're going to look at that, and instead of seeing $27, you're going to see $2,700. Because let me walk through this math real quick. Right? This is showing $27 per share. Right? We know that each option contract represents 100 shares. So we've got to take that 27 and multiply it by 100 shares. You do that, or you just move that decimal place over 2 spaces, and we now have the price that that option contract will cost us. So to tie up the right to buy Apple for a year's time, to buy it at 220, it's going to cost us $2,700, right? And we can see that price right here on the option chain. Now, if we were to buy the stock outright, right, if we were to go buy 100 shares of Apple, right, that's going to cost us over $22,000, right? Again, take this price times 100 shares. And to buy the shares of stock outright would cost us $22,100. $100 approximately. Okay, so we're controlling $22,000 worth of stock with a $2,700 option contract. So if over the next few months or over the next year, Apple really appreciates, maybe it climbs to 250 or 270, the option contract that we bought down here to buy the stock at 220 is going to appreciate in value, just like that example we used in real estate. So pretty exciting stuff. So I hope you're starting to see there are a ton of benefits of being an options trader. So just to list a few here, we've shown you the leverage that comes with trading options, how you can control stock for a fraction of the price. This makes it really small account friendly. If you're just starting out or you've got a little bit smaller account, options can make trading a reality for you. Options also give you the potential to hedge other options positions or to hedge stock positions. You can build in sleep at night protection by using option contracts in your favor. They also bring a ton of flexibility. Options can let you profit if the stock goes up, if it goes down, or even if it goes sideways. Now, when you trade stocks or you just buy ETFs or mutual funds, the stock goes sideways, your investment's going nowhere. If the stocks or the market pulls back and you're just holding these positions, you're losing value and you've got to wait for those to climb back up to start seeing a profit again. Where options, we can trade in either direction. And like I mentioned, we can even make money if the stock goes sideways. We do that by being an option seller. And we can actually generate income. We can kind of become the insurance company. We can become the Geico or the State Farm, and we can sell the option contract to other investors to generate some income and collect cash. So just tons and tons of benefits of trading options. So moving along, let's talk more about call options. So again, we've got calls and we've got puts when we're dealing with option contracts. So our real estate example, like we've mentioned, is similar to what a call option is. A call gives you the right, if you purchase a call option, it gives you the right to buy stock, to buy the shares of the underlying stock at the strike price anytime before the expiration period. Now, the great thing about options trading is you don't even need to buy the stock itself. You don't need to exercise that contract and buy the stock at all. Just like our real estate example, you can actually just turn around and sell that call option for a profit. So, taking our Apple example, right? And in our option chain we just looked at, Apple itself, the stock itself, was trading for $221 a share. And if we came in and we bought the 220 call option, okay, we came in and we bought the 220 call option. So again, the strike price was 220. And we were looking, just for example's sake, 1 year out in time. And that particular option contract cost us about $2,700. All right, so what if, right, we bought this call option, we were feeling good, we were feeling bullish, and we were right over the next maybe 5, 6 months, 8 months, 10 months even. Again, we've got a year. Let's say Apple appreciates up to $250 a share. The stock itself goes up in value. Well, if we have the right to buy the stock, right? If we have the right to buy at 220, and now the stock has gone up $30 a share. It's now increased up to 250. What do you think's going to happen to our underlying call option. It's going to increase in value as well. We know, right, if the stock's trading at 250 and we have the right to buy at 220, we know that's going to be worth at least $30, right? Remember, we bought it for 27 a share, so 2,700. And if there's time remaining, let's say it makes this move in 6 months' time, there's still going to be a ton of time value left in this option contract because it doesn't expire for a year. So that underlying call option, we know it's going to be worth at least 30. It's probably going to be worth closer to $50 in this scenario, which again, if we times that by 100 shares per option contract, hopefully your brain's starting to see this math. That $2,700 investment is probably going to be worth about $5,000 here. Again, I'm doing some hypotheticals. There's a few variables, but all you do is go check the option contract. You can see exactly what it's trading for. Or if you have the position in your brokerage account, you log into your brokerage account, you're going to see exactly what that's worth. It's going to quote you that current price. Okay, so a $2,700 investment now worth $5,000. So we've almost doubled our investment. So you think about what the stock has done in that period of time. It's gone from 220 up to 250. So still a great gain, but nowhere near a double, right? The stock would have had to go up to 440 to double your stock investment if you were just buying the stock outright. So a little, 10, 15% move in the stock can equal an almost double your investment in the world of options trading. So that's where the power of leverage can come from, right? If you're a small account, you don't need $22,000 to go buy 100 shares of Apple. You could use $2,700 and have the opportunity to make that really fun, exciting profit. So again, just to recap call options here. It gives you the right to buy the stock at the strike price. And if the stock goes up in value, that call option is going to increase in value as well. Now, depending on the strike price, depending on the expiration date, how much that call option goes up in value is going to change. But as you keep diving into options trading, a lot of these little intricacies will become really clear and apparent. But the important thing to understand right now is you're just getting started, as you're just learning the basics. If you buy a call option, that is a bullish trade. You want the stock to go up in value, just like this example we've worked through here on Apple. So next, let's talk about put options. So just opposite of a call option, where a call gives you the right to buy shares of the underlying stock, a put option gives you the right to sell shares of the underlying stock. So why in the world would you ever want to have the right to sell something? Well, maybe you actually own the shares of stock, and a put can act as an insurance policy. Again, let's take our Apple example. Apple trading at $220 a share. What if you came in and you bought a $210 strike price put, and again, you bought this for maybe out in time 1 year? Well, now you have an insurance policy on your actual shares of stock that you own to sell the stock at 210 no matter what the actual shares are trading for. So if Apple goes through a rough patch and maybe the shares drop to down to maybe 150 a share, you could come in and still sell your stock at $210 per share. You've got an insurance policy there. Now, maybe you're not a stock trader. Maybe you don't want to deal with the stock at all. Can you still use a put option? Absolutely. So just how when we buy a call option, it is going to increase in value if the stock goes up. If we buy a put option, it's going to increase in value if the stock goes down. So our put contract, if we buy that and the stock drops, our put will increase in value. We can make money. So let's talk about how this works. So again, using this Apple example, if the stock was trading at 220 and we buy a 210 put, again, just to use this same example here, and if we don't own any shares of stock at all, but again, the stock goes through a rough patch and dips to 150. Okay, maybe the market goes into a bear market, or there's a big correction, or just the NASDAQ and tech stocks get hit, right? These stocks ebb and flow. They move around quite a bit. Well, if we own the right to sell something at 210 that's actively trading on the open markets, right? If the stock itself is down at 150, but we could sell at 210, there's $60 of value in that option contract, right? There's value there that has increased as the stock drops. Because if you have the right to sell at 210, and as the stock is dropping lower and lower and lower, you can sell at that higher price. That becomes more and more valuable as the stock goes down. So an easy way to remember, buying a call option is bullish. You want the stock to go up. The underlying stock goes up, the call option increases in value. If you buy a put option, that is a bearish position. You want the underlying stock to go down. If it goes down, the value of that put contract will increase in value. So again, let's run through one more kind of hypothetical example here. And we'll contrast this exactly to that call option example that we just walked through. So again, we'll use Apple, right? The ticker symbol for Apple stock is AAPL. And it's currently trading, as I've shown on these previous screens, it's trading at about 220. So if we came in and we bought the 210 put, or sorry, the 220, let's just go right at the money. We're buying the 220 put. Okay, so same exact scenario that we just worked through on calls, but now we're dealing with a put contract. Now in our other example, Apple went up $30 a share. So in this example, let's say Apple drops $30 a share to down to maybe 190 or so. All right, if we have the right to sell the stock at 220, right? That was our strike price that we decided to trade. And maybe when we went out in time 1 year, just like our call option example. This put, if we jumped back to an option chain, it's probably going to be right around that same value of the call option. We'd probably have to pay right around $2,700, give or take maybe $100 or so. All right, so if we're paying $2,700 and the stock was trading at 220 and then it drops, remember, as a put buyer, that is going to make our put contract increase in value. But now Apple's trading for 190 on the open market. That $2,700 put contract that we bought when Apple was trading around 220 will probably have increased in value very similarly to that call option, to probably around $5,000 or so. Again, it depends on exactly when and a few different variables. But what you can see here is the flexibility that trading options can provide us. We can now take advantage of a stock going down, and we can see a tremendous rate of return, again, where we almost double our investment. That $2,700 put that we bought would now increase in value to closer to $5,000. And it does that because we have the right to sell something at 220 that's now trading down at 190. Okay, you can sell something for $30 higher than it's trading for on the open market. So that put option would increase in value. So again, buying a call option is a bullish trade. Buying a put option is a bearish trade. So when you buy a call option, you're cheering for the stock to go up. If you buy a put option all by itself, you'd be cheering for the stock to go down. Okay, so we've got buying calls, buying puts. Now, we also talked a little bit about being an option seller and selling options for income. So you can be a buyer of a call, you can be a buyer of a put, or you can actually be the seller of a call option, or you can be the seller of a put. You can actually sell it first to open the position and then buy it later to close the position. Now, when you take that side, if you are the seller, it's just the opposite of when you're the buyer. All right, so if you sell a call, you're now in a bearish position, right? So let's write down some notes here. If you buy a call option, right, like we've talked about, like our real estate example, you're wanting the stock to go up. If you buy a put contract, you'd be wanting, this is a bearish position, you'd be wanting the underlying stock to go down. Now, if you take the other side of that, if you come in and you sell an option contract first, okay, so if you sell a call option, you're just on the exact opposite side of that. And we're going to talk a little bit more about this, but you would actually want the stock to go down or sideways, and that call option can turn a profit for you. And then if you sell a put, take a guess here, it would be just the opposite. You would actually be building a bullish position. Now, the beautiful thing about selling option contracts is there's a time decay curve that works against any option contract. As you get closer to expiration, those option contracts start to lose value. Okay, so if you buy a call or you buy a put, every day that goes by, you're experiencing just a little bit of time decay. And it really speeds up into that last month before expiration, and especially that last week before expiration. That time decay gets more and more extreme. So as an option buyer, that time decay works against you. As an option seller, again, because you're taking the other side of that, it actually works in your favor. So we can make money if the stock does absolutely nothing. If it's just going sideways, our position can build profit as an option seller. So if that's rattling your brain just a little bit, pause this video, rewind it a few minutes, go through it again. But I promise there's some new terminology flying your way. This might be a new concept, but it's definitely worth taking a little bit of time to learn this. So along the lines of being an option seller, we also can build option spread positions. Now, again, we talked about how options bring a ton of versatility, a ton of flexibility, right? When you buy just a stock outright, you need it to go up to make money. With options, we can turn the dial. We can build a really bullish trade. We could build a partially a bullish trade. We could build a barely bullish trade. We could build a neutral trade. We could build a bearish, or a slightly bearish, really bearish trade. You get the idea. So this flexibility can be built through option spreads, right? So again, our Apple example here, if we came in and we bought a 220 call on Apple, that trade in and of itself is bullish. You want the stock to go up. But maybe you think Apple could go up a little bit, but it might struggle. It might chop around, or it might not just go rip-roaring higher. We could build an option spread where we're also selling maybe a 240 call along with the 220 call that we bought. All right, so a lot of times in a brokerage account, you'll see a plus sign showing that you bought the call, and a negative sign. You might be -1 contract if you sold the call. So that's how I'm illustrating that there. So to write it a little more plainly, if you were to sell, be an option seller of the 240 call, and then still have a buy at the 220 call, what we've built here is an option spread that's going to be a little less bullish, because again, buying is a bullish trade and then selling is a bearish trade. Now the way this is built, and again, these are probably both 1 year out in time. We would just use the same strike price in this spread example. There's a ton of different ways you can build option spreads. So don't worry about this too much yet, but just to start lighting up your brain. What this trade would do is it would still be bullish, but a little bit less bullish. That's called a bull call spread that I just showed on the screen there. You're not going to be as at risk to time decay. So if the trade takes a few months to get going, that 240 that we sell, the time decay is making you money, while the 220 that you bought, the time decay is working against you. So it kind of offsets that time decay that could be working against you. If it goes up a little bit, that 220 call can still be making you money, and that 240 call could actually be making you a little bit of money. So it makes it a less bullish trade than just buying the call option outright. It makes it a little less aggressive. So the reason I just introduced this concept of option spreads here, again, it's going to take a little more time to really master this and understand it. But the whole point of me bringing it up here in this video is I want to really make the point clear that you have a ton of control. There is a ton of flexibility when you become an option trader. As opposed, again, to just buying the stock, you're just kind of sitting back and hoping the thing goes up, hoping that your investment appreciates. Whereas an option trader, you can be a lot more in control. All right, so to wrap this discussion up, I want to hit on some of the risks and how we can manage the risks as option traders. So again, using our Apple example, if we buy that 220 call option and Apple just kind of trades around, doesn't really move, and we get a year down the road, if Apple was trading at 215, 218, we could potentially lose our entire $2,700 investment if the stock hasn't gone higher. So think about that for just a second. The stock hasn't really moved or moved down just ever so slightly, and our option position could lose 100% of its value because we're buying the right to buy the stock at 220. We're paying for that time if we've got a year out until the option expires. We're paying for that time. And if we get to the end of that time period, if we get to the expiration date and there's really no benefit of buying at 220, right? If the stock was trading at 218, you'd rather just buy it on the open market for $2 cheaper. That option contract becomes worthless. Now, that scenario is fairly unlikely. We'd get out of it probably beforehand, but I want to make sure you understand some of the risks. And that's one of the misconceptions that people have about options trading. Oh, they're so risky, they're so risky. And from that perspective, yes, losing 100% of your investment when the stock's only dipped maybe 1%, that can feel risky. But there's several ways we can manage our risk. First, you make sure you position size correctly, where if there were to be a loss on that option contract, it isn't devastating. You understand how you are protecting yourself by starting the position with the correct size in the first place. Another way we like to manage a long option position, whether we buy a call or we buy a put, is if we get to where it's lost 50% of its value, we just close it down. We kind of have a stop loss, if you will. So again, if we buy something for $2,700, if we buy a call or a put, we would stop out of this if it ever got down to where it was worth $1,350. We would just close it down. We'd jump out. We'd say, okay, this one didn't work, and we'd close it. So there's different ways you can build in rules to really manage your risk and to minimize your losses. Because again, like we've shown you in a few of these examples, there is huge potential in a stock making a small move and your option contract making a giant increase in ROI and profitability. So we can really maximize our gains. And if we're disciplined and we have our rules that we follow, we can minimize our losses as well. So again, the point of this video is to hopefully just start getting you familiar with some terminology, familiar with call options, put options, that there's a ton of potential trading option contracts. If you need to go through this video again, by all means, go through it, pause, write down notes. It'll start to click. And then here at Trader's Edge Network, we have a ton of information, training videos, books that can help you along your path to mastering options trading. So I hope you continue to dive in and continue to learn, because it's definitely worth it. Take care.